so say hello to Dotson if you can. He has a lot of money to invest now, so jack him up a little bit. I used to be an entrepreneur, but even back then I was angel investing. But I only built the confidence to become an institutional VC investor after my first exit. So before the LPs, I had my wife at home to impress. And so, because she always felt, what's this stuff you're doing, throwing money away, investing in companies that will never come back? And so the theme of performance has been something that I've obsessed about from day one because I started investing my own money. And so when I was looking at the slides from Maxine, I was taking lots of photos. The one that showed sort of the scaling of venture dollars flowing in, right at the bottom there in 2014, I believe 2013 was when I made my first angel investment. And so it's been incredible to watch the ecosystem grow since then. And I've been asked this morning to share a few thoughts about how, as an ecosystem, we might move from potential to performance. Now, before I dive in, I'd like to ask a question. When you think about Africa and potential, what two-word phrase comes to mind? Besides Africa potential, of course. What comes to mind? Anyone? Yes, please. A mic for him, maybe? Connectivity. It has to be a two-word phrase. It's a good one. Access to market. Great. Maybe one more person. Access to talent. How about this one? Africa Rise. You've all heard it before, right? I think the first time, I forget who made this phrase very popular, but the first time this phrase made the cover of a major magazine was in March 30th, 1998. I wasn't investing at that time, but folks were already talking about Africa's potential. In December 23rd, 2011, The Economist joined the bandwagon of people that heralded the potential of this great continent. And then things didn't quite happen, or didn't quite happen as fast as we thought it would. But yet, about a year later, Time magazine gave it a go. And so, rumors of Africa's potential have long been celebrated across the world. I would argue that one of the major promises of the 21st century has been stories of Africa's great potential. But is this potential real? What do you think? By 2050, 1 in 4 humans will be African. So talk about human potential. At the same time, close to 70% of that population will be people under the age of 30. This continent would have the largest proportion of its citizens under 30. By extension, it also suggests that we would also have the largest workforce in the world. Some of those people will work here in Africa, some of them will work for global companies remotely or by emigration. I don't care what anyone tries to do. We are the workforce of the future. But we're also seeing that over the next 30 years, African economies are projected to grow the fastest. And yes, you could argue that other continents are already starting off from a very, a large base. But I think this is really important to track. Your GDP doesn't quite speak to all aspects of human development, but I think it's an important indicator. Moving away from demographics, under the earth that we walk on, there's tons of potential. Africa has about 65% of the world's arable land. Ignore the typo. It looks like my slides have been compressed, the text have been compressed on the big screen, but you can read it. The continent also has the largest reserves of minerals like cobalt, diamonds, and uranium. So it's not all about human potential and code and whatnot. There's real viable stuff on the continent. Our minerals are needed globally across supply chains for mobile phones, for electric vehicles, and all sorts of applications. But even though Africa doesn't quite feed itself today, the continent has the potential to feed the world. And as we continue to invest in hyperscalers and data centers around the world, energy becomes even more critical. There's sun all over the continent. 60% of the world's solar potential lies here in Africa. And going back to demographics, as that population grows, remittances would also expand. And remittances are important because yes, someone can receive money and go marry another wife, but they can also invest in a startup. So there's lots of potential in Africans that migrate to other parts of the world. Guys, there is no doubt that we've got potential. Thankfully, we've also seen a consistent wave of innovators building to take advantage of that potential. So first you've got potential, and then you've got innovation. And I know there's a couple fund managers in the audience. Across your portfolio, you have many examples of these. But I like to use one company as a case study because I think it tells a really good story of how you can take advantage of African potential, to build something that, provides a better future. So my example today is a company called Paystack. Some of you are familiar, but this is a really interesting statistic that I'll share with you. The company was founded in 2015. A year before Paystack was founded, less than 1% of electronic individual payments in Nigeria were electronic. Less than 1% of payments by individuals in Nigeria were electronic. 1%. At the time, the Nigerian population was about 189 million. Fast forward to 2024, over 60% of individual payments in Nigeria are electronic. Talk about taking advantage of potential. In 2020, the year Paystack was then acquired by Stripe, $1.4 billion was invested in African startups. A year after that exit, that number grew 4x, $5.2 billion. Yeah, you might say it was ZERP influence, interest rates were low, blah, blah, blah. But I argue that people were attracted by the promise of performance. The Paystack exit by a globally recognized payment leader was a whistle that something was happening here. In the same year, we launched our last fund. I'd never seen this before. I had all types of people in traditional businesses phoning me wanting to invest in our fund. 70% of our first close LPs were Africans. Not DFIs, guys. 70% of our first close were Africans. We had one DFI in that close, but there was an overwhelming interest from local capital allocators to invest in startups. Clearly something was happening. Since that time, African startups, and I think my data correlates with Maxine's data because we're all using your data anyway, so thank you, Maxine. Since that time, African startups have raised a total of $18 billion. And fund managers dedicated to Africa have raised another $2.3 billion since 2020. Pretty easy math to do, but that number comes to about $20 billion in monies that have either been invested in Africa or earmarked for Africa. So let's do some math. Before the math. In that time, we've recorded about 9 IPOs above 100 million. And those IPOs all total to about 2.6 billion. Now, this number doesn't account for secondary exits. At Ventures Platform, we've done a number of secondary exits and returned a few vintages that way. So secondary exits are important. But we're not tracking those secondary exits as well as we should. And it's probably a good point for me to pause and share with you that, actually, before I share that, let's do some math. So you've got 20 billion in aggregate funds that have been raised, invested in startups or earmarked by funds to invest in Africa. If we assume that venture funds like ours have to return something in the order of magnitude of 2 to 2x in DPI as our target, that sort of exit value that you require over the next 10 to 20 years sits somewhere in the range of 40 to 60 billion. Right now, we sit at 2.6 billion. So there is a bit of a performance gap. And you can call it 40 billion, you can call it 60 billion. But as a market, we have to deliver something in that magnitude. It's not absolute numbers, right? Because some of the monies have flowed into startups, some have flowed into funds. But that's a number that I think we need to think about. And so the real question ahead of us is, how might we move from potential to performance? How might we thoughtfully and deliberately start to make that transition from an ecosystem that's about hype and about potential, but one that delivers performance? In venture capital, performance is simply one thing: DPI. Distributions to paid-in, that's it. And look, I love impact like the next guy. We need jobs in Africa. And the hype is important, because how do you sell a market without hype? But DPI is the only thing that keeps the wheels turning. And so we need less conversations about impact, less conversations about jobs, more conversations about liquidity. Because I believe that impact, jobs are an outcome of building sustainable companies that deliver performance. And I think as fund managers, we all have to remember that the customer is the acquirer. I know it sounds controversial, but we're in the business of building companies that can get sold. The startup founders are users. Their customers are secondary users. But my customer is the acquirer. And so what might we do? How might we rethink or improve or modify our ecosystem as we enter the next chapter? I've got 8 ideas that I'll share with you. These are ideas that we debate at Ventures Platform amongst ourselves. And if you want more ideas, you should read Ido's. I don't agree with everything Ido said, but I agree with most of it. You should check out his article. Ido is sitting behind. Shout out Ido. So I think we have to first acknowledge that our ecosystem is early. And because that ecosystem is early, I mean, think about it. You don't go to the gym after being out the gym for all your life and try to bench press the biggest weights in the gym, right? You start with the barbell with no weights, and you build your muscle. And so we have to recognize and acknowledge that our market is still early. And because the market is early, we have to bake that into how we think about the scale, the type of companies, the paths to exit, the kinds of business models that we invest in. And, in Ido's article, he does a really fine job of situating our ecosystem on a timescale relative to some other ecosystems. I do feel that you can't simply transpose ecosystems in timescales because there are lots of effects that are not linear. But we have to recognize that this is an early market, and it has to be built in a certain way. As founders and investors, we can't simply invest in any kind of company. You can't simply do a startup that you see in the US, in Africa, because Africa needs a particular kind of innovation. And we believe at Ventures Platform that we ought to invest in market-creating innovations, because these innovations target what we have the most in Africa, non-consumers. And a great example of that is a company called MoneyPoint, a company that probably wouldn't exist in any other part of the world, but exists here because you had chronic non-consumers of financial services. African startups have to have healthy unit economics from day one. We can't afford the luxury of subsidizing growth. And companies like Omni Retail are demonstrating that by prioritizing business models that are capital efficient, they can get to profitability and be more sustainable quickly. Our founders need to build highly capital efficient companies. And sometimes this means founders have to have the key resources they need in of themselves. So if you're building a software company, you have to be able to build the first version of that startup because you may not raise a ton of money. And a great example of that, again, is a company like Paystack that raised less than $12 million and sold for $250 million. Fantastic outcome. It was a great outcome for me and several other people. It didn't have to become $1 billion or $2 billion to produce a great outcome. And I think you can even have great outcomes at far less than that, 50 million, 75 million. It's a function of how much capital a company raises and the size of the venture funds that back them. Companies need to be priced at valuations that make them attractive and practical for the corporates we have on the continent to acquire. If a company gets too large, then it's out of the nexus of what is possible to be acquired here in Africa. And that's great, but we can have success at various levels. I love unicorns like the next guy, but we're not all going to build unicorns, right? As Maxine showed us, thankfully, we're seeing more debts, but we need lots more. We need all kinds of products. It can't be equity alone. Because this would help companies extend runway, reduce dilution, and improve the odds of survival. I believe that our government needs to designate startups as a critical development asset class. Because when you do this, you can then start to bring a whole of government approach to it. So in Nigeria, for instance, you don't have one government agency trying to kill startups while another one is trying to support them. This will be critical to expanding TAM and scaling the companies that we're investing in. In closing, it's a multiplayer sport. So we will need governments like the government of Cape Town that's supporting this conference, regulators, capital markets, exchanges, local exchanges, venture capitalists, and founders to work together to really jumpstart and accelerate the market for local liquidity. It's not going to happen if we don't deliberately orchestrate it. Thank you very much.